Wealthy people love investing for cash flow. That means you're taking your cash, you're buying an asset, and now this asset is paying you every single month, and if not every single month, at least every single year. What's up, everybody? I am Jaspreet Singh from theminority-mindset.com, where money minds rethink rich. There are two different ideas or strategies when it comes to investing your money. One way is investing your money for growth, and the other way is investing your money for cash flow. When you invest your money for growth, what you're trying to do is you're trying to find some sort of asset. Let's just make it simple, and let's assume you're investing in a startup company, and you're investing in this company because you hope that you invest this $1,000 today, and your $1,000 is going to hopefully one day be worth $10,000, but we don't know when that day is going to come, and we don't even know if that day is going to come. But when you invest for cash flow, now what you're doing is you invest this $1,000 today, that way you can start getting paid consistently. Now you're getting paid while you wait. Hopefully, your hope is your $1,000 will grow to something bigger, but even if it doesn't, you're getting paid consistently for the cash flow that you're getting monthly or yearly. Now, these don't have to be mutually exclusive. You don't have to be somebody that only invests for cash flow or the person that only invests for growth. You can do both. You can have some investments that pay you with growth, some investments that pay you with cash flow, but you have to understand your goal when it comes to investing your money. That way, when you make an investment, you got to know, am I looking for growth or am I looking for cash flow? I like investing in both because they both provide different values and they pay you in different ways. I like investing for growth because it gives me more upside potential. I like investing for cash flow because now I can start stacking my cash flow. If I can start buying assets that pay me $100 a month each, now all I'm trying to do is play the stacking game. How many of these assets can I stack up that are each paying me $100 every single month? At that point, it just becomes a numbers game. How much income am I looking for? If my expenses are $3,000 a month, and I know that each asset that I buy can pay me $100 a month in positive cash flow, that means I just need 30 of these assets. I need to own 30 of these investments that are now going to pay me $100 of profit every single month. And then if I can hit that, now I'm financially free because I have enough assets paying for my expenses because I got the cash flow. And if you do this the right way, not only are you going to be seeing this cash flow, but you're going to see this cash flow grow, and the asset that's producing the cash flow will also become more valuable because you bought the right asset. So what I want to do today is go over 3 different ways that wealthy people invest their money for cash flow. That way you can get paid while you wait. But before I jump into these 3 things, I need you to do me a quick favor and smash that thumbs up button below. And a quick word from our sponsor, NorthOne. If you are a small business owner or you're a side hustler, you need a bank account that will help you manage your business's finances. NorthOne created a special business bank account made specifically for small business owners and side hustlers, which let you do everything off of your phone. That way you don't have to go into a bank ever again. Now you can make and receive ACH payments, and you can deposit your checks right off of your mobile app. When you open up an account with NorthOne, they'll give you a debit card just like this. That way you can make transactions easily, and they will sync directly with your accounting software. That way you don't got to waste a whole bunch of time trying to figure out how to do your accounting and your taxes. Plus, they also have an envelope feature, which makes it super easy for you to save money for things like your payroll or your rent or even your taxes. That way you can budget for these things as you get paid. And the best part of all is that NorthOne is giving you, Minority Mindset fans, $10 for free when you open up an account and fund it using our link. So if you want to learn more and see how you can get started with NorthOne, I'll put the link to where you can do that in the description below. The first way that wealthy people invest for cash flow is by investing in cash flow producing businesses. So I like investing in startups. That's one of the things that I like to do just because I'm an entrepreneur. But one of the downsides of investing with startups is that you don't get paid unless the startup really succeeds and they get acquired, meaning they get bought out, or they go IPO, meaning they go public on the stock market. Now, the nice part about that is if the company you invest in does reach that, you can see very big returns. But it also comes with a lot of risk because most of the companies that you invest in will go completely bust. They're going to go to zero. So you don't get paid while you wait. You invest and then you hope and hope and hope and hope that they become something bigger. That way that you can actually, hopefully one day get a payday. When you invest in a business for cash flow, you're doing something completely different. Now what you're doing is you're looking for a company that's profitable, and you're going to now come and buy the assets. You're going to be the owner of the company. That way you can get your share of the profit as opposed to being just a worker in the company. You're going to buy the company. That way you can get the profits, and this profit is now your cash flow. Let's assume for the purposes of this example that I own a company that sells markers for whiteboards. And this company does $100,000 a year. And out of this $100,000, $70,000 are my expenses. So a portion of these expenses, so this is all my $70,000 worth of expenses. A portion of these expenses are going to be my costs of goods, COGS, cost of goods sold. So this is the money you have to pay for the plastic and for the ink and all of that. Part of this money is for my packaging. And let's assume that part of this money is for salary. So maybe there's an employee, it may be a part-time person that helps kind of run the business. So I have to pay $70,000 a year to run the business, and then this is my profit. So all of the expenses to run the company are $70,000, and then this leaves an extra $30,000 a year in my bank account. This is the profit. The person who gets this profit is the owner of the company. Now, in this case, I'm the owner of the company, so I get to keep this $30,000. And I can decide either I'm going to take this $30,000 and reinvest it back into the company, that way we can grow bigger, or I can take this $30,000 and go buy myself a new car. It's my choice. But now, what I'm trying to do is I might want to sell this company because maybe I own the company and I don't want to continue working to help grow the company. I don't want to have to keep dealing with the headache and the risk of being in this business, and I just want to get out. I don't want to keep making this $30,000 a year on profit. Sure, maybe I get the salary. Maybe I don't even work in the company. Maybe I've hired somebody to work here, and so this business is completely hands-off. Now, what I can do is I can sell you this company. Maybe I'll sell it for, let's say, 5 times earnings. So I'm going to sell it for 5x profit, which means I will sell you this company for $150,000. Now, what you do, you pay me $150,000, you get this company, and now you are entitled to these profits. Again, you don't have to work here. You have other people running the business. You have other people handling this. All you're doing is you're entitled to this extra cash at the end of the year. Now, what you want to do, if you really want to do this the right way, is you want to come and buy this company that you don't have to physically work in. You don't want to buy a company that you have to work to get your payment, because now you're an employee, you're not the owner. You're trying to buy the cash flow. You're not trying to buy another job. So you want to buy this company, that way you can be entitled to this cash flow. But what you want to do is come up with ways to grow this cash flow. So ideally, this is in an industry which you're aware of, that you understand, that you can come and add some value. So if you're in the fitness space and you find a gym that you can add some value, now what you can do is come in and add your new workouts, you can add your new machines, you can add your new marketing, whatever you can do. That way you can increase the value of your company. That way you can increase the cash flow. The key for this to work is you want to make sure that you're buying businesses that you don't have to physically work in yourself. You want it to be a hands-off business. There's a lot of different businesses out there that allow you to do that, but you want to make sure that you're finding a business, if you're trying to get this type of cash flow, that you're buying a business that produces cash flow that doesn't need you to physically work there. Sure, maybe you got to manage the business, or you can hire somebody to manage it for you, but you want to make sure you're just buying a business that you don't have to physically work in, because you don't want to be the employee, you want to be the owner. There's a lot of different ways to do this. You can look for franchises. That way they're already established companies, and maybe you got to work to get it set up. But after that, it can be hands-off depending on what the franchise is. You can buy out an existing company that's for sale. This might be an independent company, not a franchise. You have these type of companies in every single industry. Or you can consider starting your own company, but that takes a lot of work. That is the most work to get started, but you also have the most potential upside and the most risk. If you want to start your own business, you have to have the entrepreneurial mindset. There's a whole bunch of crap on the internet of people selling this idea that you can start a business with very little work, with very little capital, with no effort, and you'll be able to scale your business to 6 figures a year by following the secret system. Well, if that secret system really existed, then everybody would be doing it, and it wouldn't be so dang hard to start a business. That being said, if you do have the entrepreneurial mindset, it is much more accessible to start a business nowadays than ever before, thanks to the internet, because now you can start a business with pretty much no money. I mean, you can start a blog, you can start a YouTube channel, you can start a podcast, and all these things can now funnel leads and revenue into your business, which then you can reinvest to create your own product. Like Minority Mindset started off as a social media page. It started off as an Instagram page. Then eventually I started a YouTube channel. I didn't buy any fancy equipment. I just started making videos off of my iPhone. I mean, I didn't have anything. I was recording in front of my white wall. I bought a $20 or $25 tripod. I bought a $25 light, and that was it. I didn't have a microphone. I didn't have a fancy camera. I didn't have fancy editing equipment. It was like less than $100 worth of equipment, and I just started making videos talking about the things that were important to me and talking about the things that I wish that I would have learned when I was getting started. Then Minority Mindset started to grow as a YouTube channel and I had to make a decision. Is this something that I wanted to pursue, or should I continue pursuing my other business ventures? Well, I really liked the whole idea of spreading this type of financial education, so I dove deeper into it, and now Minority Mindset has grown from just one YouTube channel to one of the fastest growing financial media and education companies on the internet. It all started with just making videos off of my iPhone, but it grew into something a whole lot bigger. So you have so many opportunities to start a business if you have the entrepreneurial mindset and the entrepreneurial bug and you're willing to work your butt off. But if you're not willing to do that, then don't try to start your own business, but you can buy a business where you can try to see where you can increase the value. But again, in order for this to work, you have to make sure that you're doing it in a hands-off way. Now, if you don't have access to a lot of capital, you don't have access to a lot of cash, this is going to be harder to do because you're trying to buy somebody's cash flows. You're trying to buy somebody's profits, and you can pretty much estimate that you're going to be paying somewhere between 2 and 10 times profits depending on what the industry is. So if a company is making $10,000 a year in profit, you can expect to pay at least $10,000 to $15,000, if not $20,000 to buy that. And it could potentially be anywhere up to $100,000 depending on what the upside is, depending on what the industry is. Every industry, every sector, every type of company, every stage of company is going to have a different multiple. So I can't really just give you one size fits all, but you have to understand if you're trying to buy somebody's cash flow, you need some cash in order to do that. Now, if you don't have any cash, then it's going to be harder for you to do this without actually working there. But there are other ways. I mean, there are creative ways for you to go out and buy a business by having the seller finance the business for you. And then you might have to physically work there to help grow the company. And then you can eventually hire yourself out, hire somebody to take your spot. And then if you can build the company even bigger, now you can own the cash flows. So it's a way for you to get started without investing a whole bunch of cash yourself, but it takes more work and you got to be more creative. And you're going to need, again, the entrepreneurial bug. The alternative to doing all of this is just by finding a company on the stock market, a publicly traded company that's paying out a dividend, and now you just invest your money into this dividend-paying company because now this company is already profitable. That's why they're paying a dividend. And now what you're doing is you're buying the company, ideally because you believe in the future of the company, but in addition to that, they're paying you a dividend, so you get paid while you wait. So maybe you go out and you find a company like McDonald's, and you're like, okay, McDonald's has a lot of upside. I like McDonald's. I'm not telling you to invest in McDonald's, just an example, and McDonald's pays a dividend. So because I believe in the future of McDonald's, I want to invest in McDonald's, but they're going to pay me while I wait. So you buy shares of McDonald's, and every 3 months, every quarter, they're going to pay you a dividend just for owning their company. Now, the advantage of investing into a dividend-paying company like this is it's completely hands-off because now you don't got to do any work. All you got to do is find the right company to invest in, and then you buy it, and then you let McDonald's and the employees and the executives do all the work. And if they do a good job, well, then you will continue getting your dividends. But the risk now is if they screw it up, you're not going to get any dividends because they can drive the company into the ground. And the returns that you're going to get with investing in a company on the stock market would be lower than investing into a company like this because, well, this has more potential risk, more potential upside, and now you are in full control here. You own the whole asset, and so you have the ability to get more upside here versus just investing in a dividend-paying company in the stock market where typically you're going to get somewhere between 2 and 5% a year in dividends. Can you find more? Sure. You have some companies that pay higher dividends, but in general, they're somewhere between 2 to 5% a year. Here, you can get a much better return on your money. If you invest $150,000, you make $30,000 a year in positive cash flow. That would be a 20% return on your money. Now, obviously, yes, this has more risk, which is why you also have more potential upside. So you got to understand where you want to be and how involved you want to be. The second way that wealthy people invest their money for cash flow is by investing your money into rental properties, real estate. Because now what you're doing is you're buying a property, not just to hold on and hope that this property will be worth more at some point in the future. You're buying a property, that way you can rent it out, and now somebody else is going to live in or use a property, and during the time that they're living in or using a property, they're going to pay you rent. So you're getting paid while you wait. See, when most people buy a home, here's what they do. They buy a home like this. It's a beautiful home. They really like it. They live there, and they bought the home for $200,000. And then they hope that one day, when it comes time for them to sell, they'll be able to sell their home for $300,000. Now, we don't know when this day will be, and we also don't know what the economy or the market's going to look like when it comes time for them to sell. Maybe the economy will be booming, and they'll be able to sell it for $300,000. Or maybe it'll be a slowdown in the economy and the real estate market crashed and they can't even get $200,000 for it. We've seen this happen time and time again in the past. Not just the 2008 crash. That wasn't the first time we saw a real estate crash. We've seen real estate crashes happen time and time again. Now, the 2008 crash was obviously an exception, but we see real estate fluctuations. They're cyclical. You see prices go up and down. So when I talk about investing in real estate for cash flow, What I'm talking about is buying a property, not to just live in yourself, but to buy it so you can rent it out to somebody else. That way they can pay you for cash flow. I'm a real estate investor. I don't care what happens to real estate prices. When I look at real estate, the only thing that I care about is how much money do I have to invest in today and how much money am I gonna get paid every single month. That's what I'm paying attention to. If real estate prices go up, great. If they go down, oh well. What I'm paying attention to is how much do I have to invest and how much return am I gonna get. My goal when I invest in real estate is to get a minimum 7% annual cash on cash return. Now, if you compare this to that business example, this is going to seem a whole lot less because in a business, you might be able to get a 20% cash on cash return. Here, I'm only getting a 7, and you're right. But the advantage here is this can be completely passive. When I buy a good rental property, I'm going to hand over the keys to my property management company. There's a whole bunch of property management companies out there. You give them the keys to your rental property, and now their job is to manage the property and make it completely passive for you. So they're the ones that are finding you tenants. They're the ones that will have to fix the toilet when it breaks at midnight. They're the ones that have to pay the bills. They're the ones that make sure that everything is running smoothly with the rental property. And then every month, they're just going to send you a report with their check with the profits. And so what I'm trying to do is I'm just trying to get this 7% return consistently. So I'm looking at how much money do I have to invest, how much am I making every single month, and if it adds up to 7%, then this is something I'm going to consider. Now, I'm also looking at what is the area. The location is important. Are businesses flowing into the area? Is there population growth in the area? Is there growing demand to be in this area? I don't want to invest my money into a place where everybody's trying to move out of, where businesses are trying to move out of, where crime is increasing, where people don't want to be. Because in 5 years, it's probably going to be worse now than it is then. That's why I spend the time to research the locations. I want to know exactly where I'm investing, and I want to know the neighborhood. I want to know what kind of area it is. I want to know, are businesses moving in, what businesses are moving in, and are people trying to move into this area? Because real estate is a long-term game. It's not something you invest in for 6 months. You invest in real estate for years. And so I want to see areas with growth. And if you see an area with growth, then guess what? Sure, maybe this property will rent out for $2,000 a month this year, but in 5 years, maybe somebody will be willing to pay $3,000 a month because now they really want to be in this home because they love the area. The demand for this area has gone up, so they want to be there. That's why the location is so important, not just so you can see this upside because the demand has increased, but so you can get better cash flows because now people want to live there. I can't emphasize how important this is because you can change everything about a real estate property. You can change the windows, you can change the door, you can renovate the property, you can add in a better bathroom, you can change the landscaping. But the one thing that you cannot change is the location. And so if you buy a property in a crappy location where the location is getting worse and worse, you can do everything to renovate the property. You can put in $100,000 to make it look nicer. But if it's in an area where nobody wants to be, you're not going to be able to get good rents to justify the property. But if you own a property in an area that's growing, that's a place that people want to be, well, now not only are you not going to have a hard time finding tenants, but you're also going to be able to charge better rates for your tenants because now people want to live there. And if more people want to live there, well, then that means you can charge more money on your rents, which means over the years, you will see your cash flow go up. Now, a little warning there. What I don't want you to do is invest into a property based off of future cash flows. You see this happen all the time, where people will offer you an apartment complex and they'll say, okay, buy this property for $1 million today and it's going to be a 3% return this year, but in 2 years, you will start getting the 7% returns, assuming that you can increase rents by 10% a year. I don't like to make those assumptions. That's speculating. I don't like to buy based off of future possible rent growths because there's a chance that will not happen. There's a chance we could see an economic slowdown. Is it possible? Yeah, I don't know how possible it is, but it is possible. So when I make my investments, I want to make my investments based off of today's prices and today's rents because what I want to do is I want to make sure I have a cushion. In case things slow down, I want to make sure I'm always protected. And so if things do slow down and I have to cut the rents, I want to make sure that I'm protected and that I'm not having to go into my pocket to cover the expenses of the property. So when you do these type of real estate investment decisions, you want to make sure you're smart and you want to make sure that there's enough profit there with enough cushion to cover the expenses and a potential slowdown. And the third way that wealthy people invest their cash for cash flow is by turning their cash into an asset. So watch this. When you take your cash and you put it in your hand, this cash is a liability because every single day the value of your dollar is dropping because of inflation. As the money supply goes up, the value of your dollar goes down, and as buying power goes down. So when you take this cash and you invest it into the bank, what you're doing is you are investing a liability. So your cash sits in the bank, it's a liability because your money doesn't grow. It just sits there, it's dead. But at the same time, the price of everything around you keeps going up because that's what inflation is doing. It's diluting your buying power, which is making the price of things go up. This is why your rent keeps getting more expensive. This is why your groceries keep getting more expensive. This is why your vacations keep getting more expensive. As the value of your dollar goes down, the price of things go up. So when you keep this money in the bank, your cash isn't growing. It's just sitting there. But when your bank gets this deposit, they take it and they turn it into an asset. So this cash is a liability for you, but it turns into an asset for the bank because what the bank does is they're gonna turn around and they're gonna lend your money to this person with a very nice mustache over here, and they're gonna say, hey, how about you take your liability? So they're taking your liability. This is you. I'm gonna draw you a braid for our female followers, or as we like to call it in my native language, Punjabi, a gut. You deposit this cash into your bank. This is a liability. The bank turns around, turns your cash into an asset by lending it to the person with a mustache. And now this person with a mustache is gonna say, hey, I got this cash. I can go and spend it somewhere. So this person with a mustache is gonna go buy some nice guacamole. But what they have to do also is they gotta pay the bank back interest. And so this is how the bank can turn your liability into an asset because they're lending your asset out and they're getting paid with interest, and this interest is more than 0%. If you've ever borrowed money from the bank, whether it's in the form of a mortgage or in the form of a car loan or the form of a credit card debt, you're not paying 0%, but they're paying you 0%. So the bank gets to take your money for free and then lend it out. They make 4 to 20% a year in interest and they pay you nothing. And so what you want to do is you want to try to be the bank. Take your cash and turn it into an asset by lending it out to somebody else. See, when the bank lends you money in the form of a credit card and you spend this $100 that you don't have, you have to pay this $100 back plus interest, but the bank doesn't have to do any work to get this money. They're letting you go work, you're working a job, that way you can pay this money back plus interest. So it's a cash flow producing business for the bank because they're just lending money out and they're getting paid with cash flow. This interest plus their principal back. Now, is there risk associated with this? Absolutely. There's a chance that this person with a mustache is going to default and they can't pay all their money back for all this guacamole that they were eating. And so they factor in that risk through the higher interest rates. So this is something that you can do, but you have to understand the risks. There are tons of platforms on the internet that will allow you to lend money to somebody else. Either it's lending money to somebody else, that way they can just borrow it to do whatever, or you're lending money to somebody else, that way they can borrow your money to go out and buy real estate or buy some sort of hard asset, and then this asset is collateral for the money that they're borrowing. Again, just like everything else, it has its own fair share of risk because now this person can default, they might not pay their money back, but if you have some sort of collateral like real estate attached to it, then you can foreclose on this property in case they don't pay you back. But this is something that you can take a look at, lending your money out because now you're taking your cash, which is a liability, and turning it into an asset, which is now paying you with cash flow because your cash is going to somebody else, and now they're using your cash, and in exchange for them using your cash, they're going to pay you with interest. Another way that you can do this is through cryptocurrency, which is very popular because you have exchanges which will let you buy something called stable coins. Stable coins, or some of them at least, are pegged to the value of the US dollar. So you have these stable coins where one stable coin is worth $1, and these stable coin companies will hold enough US dollars to cover however many stable coins are bought. So if somebody buys 100 stable coins, the stable coin will buy $100, or they will get $100. So that's the way they work. But the interesting thing about stable coins is you can put these stable coins into something kind of like a money market account. They're not exactly a money market account because they're not banks and they're not FDIC insured. But you take these stable coins that you buy, so you take $100, you buy 100 stable coins, and then you take these stable coins, you put them in one of these interest-bearing accounts, and now these interest-bearing accounts will pay you somewhere between 7, 8, and 9% a year in interest on your stable coins, and then you can convert your stable coins to cash at any time. Now again, this is not completely risk-free because these financial service institutions are not banks, so they're not FDIC insured. And so if the person that the institutions are lending to and all of them default, well, now there's a chance that you wouldn't be able to get your money back. And so you have to be kind of smart when you do this and make sure that you're working with a financial service institution that's reputable, that's lending these cryptocurrencies to people that are also credible. And so you want to make sure that your money is protected. But it's a way for you to now get better interest rates on your money by, instead of just keeping your money in cash, taking your cash, putting it into one of these stable coins, and now these stable coins can generate you interest, which you can convert back to cash at any time. Remember, just like everything else, it's not completely risk-free. There are risks associated with it. Just like how you can invest in a business and it can go bankrupt, there's a chance that something could happen to your stable coin, or something can happen to the financial services institution which is holding onto your stable coins. And so if something happens to the cryptocurrency market, you want to make sure that your stable coins are protected, so you want to make sure that you understand the risks, but it can also generate you great returns. So if your goal is to invest your money and start generating cash flow, the first thing you got to do is understand which asset class you want to invest in, which pays you with cash flow. Then you want to start getting educated and try it out. Dip your toes on the water, that way you can see what it's like. That way you can start stacking your cash flow and build it to a point where now you can start living off of your cash flow. If you like what you saw so far, then you're gonna love this. When I used to think of multiple streams of income, in my mind that meant, wow, in my bank account, that means one week I might get a $1,400 check from one place, and then a $400 check from somewhere else, and then the next week I might get a $600 check from somewhere, and then a $400 check, and then next week a $1,000 check, and then a $300 check. The whole idea is you're not just making income from one place anymore, you're making income from 4, 5, 6, 7 different places. So you just quadrupled your income because now you got multiple streams of income coming in. But the reality is it really doesn't work like that. Let me start by talking about the 7 streams of income that millionaires have. This is what every media company on the internet talks about when it comes to millionaires and how they are rich. It's because they have these 7 streams of income. So one is your earned income. This is the money you make from your job. One is your stock dividend income. One is your rental income from your real estate. One is your capital gains income from selling your investments and assets at a profit. One is your interest income. One is your profit income from your businesses. And I am missing one. One is your royalty income. That sounds great. You go to work to get a paycheck, and with your paycheck, you get 6 other paychecks too, because you got these multiple streams of income working for you. Here's the thing. If you want to create an income stream, you got to invest one of 2 things. You got to either invest money or you got to invest time. Like if you wanted to start this business and get this business paying you money, either you got to invest your time to build this business and get it going, or you got to have the money to fund the business and have somebody else run the business. That way it can make you some money. If you don't got money, then you got to invest your time. But there's only so much time in a day. Like there's only 24 hours in a day, and there's no way for you to build 7 different businesses or 7 different income streams at once. That means if you want to create multiple different income streams, you got to be investing the money. But if you don't have the money to invest in 7 different income streams, then you're just gonna dilute yourself way too thin and create income from nowhere. The whole idea of multiple streams of income makes sense because now you're not relying on one income. Like if you have this accounting business and you only have one client and this client leaves you, now you have no more money coming in. But if you have 5 different clients or 10 different clients and one leaves you, it's not as big of a deal. Same with your job. I mean, if all of your money is coming in from your job and you have no other streams of income, and then you get fired from your job, now you got no other money coming in. There's a few different strategies or ways to look at multiple streams of income. One way is, okay, I want to become wealthy, and so I'm going to do a whole bunch of different things because hopefully one of these things is going to stick and make me very successful. So I'm going to start this e-commerce business, I'm going to do freelancing, I'm going to do this affiliate marketing, I'm going to do the side hustle, and I'm going to do a bunch of these things, and hopefully one of these is going to make me a millionaire. Number 2 is, okay, I go to work every single day and I make a good paycheck, but then I'm gonna invest some of my paycheck into real estate and stocks and these passive investments. That way now I can create new passive streams of income. And number 3 is I'm gonna put all of my eggs in one basket and I'm gonna work really hard to do this one thing and create this one stream of income really big. And once I do that, then I'm gonna have more money to invest into a whole bunch of other things and create more streams of income. Let me start by talking about number 1, because that's where I used to think when I started my entrepreneurial journey, because I used to think that becoming wealthy was kind of like a ladder. I'll show you what I mean. Here's how I used to look at multiple streams of income. I used to think that multiple streams of income and wealth kind of look like a ladder like this, where each one of these steps was a different type of income that you would create. So one might be your e-commerce store, one might be freelancing, one might be doing affiliate marketing, one might be a side hustle and cutting people's grass, and one might be, I don't know, selling cakes. If you create all these different income streams, this ladder, then eventually you're gonna get to the top, and this is where wealth is sitting. So if you can create multiple different streams of income like every millionaire has, then you will have the income coming in to help you climb up this ladder and reach wealth, because that's where everybody wants to be. We all want to be at the top of the ladder. And so this is exactly what I was doing. I started off over here working at weddings. And then I had the idea with a partner of mine to start this event planning business. This is still in high school. And this event planning business and this wedding business that I was working on carried on into college. So I'm doing these two things. And then a friend approaches me with the idea to start this t-shirt business because a bunch of people are buying t-shirts in college and we can make a lot of money selling these t-shirts. So now I got this t-shirt business that I'm also kind of working on in addition to that. And then I'm starting to see people make all this money in the stock market because they're trading stocks, they're trading penny stocks. I have no idea how this works. So now I'm learning about stock market trading and trying to make some money in the stock market. And then I go to this seminar and this guy is talking about this college painting business that we could start, where essentially we could run our own kind of mini business and hire people to paint people's homes and make a lot of money doing that. So I didn't actually do this, but I almost started this college painting business. But now the way I look at it is I got a bunch of different things going for me. None of them are really making me that much money. My event planning business was doing pretty good, but the other things were not making me that much money. But I have all these things just in case, because if one fails, now I got a backup. I'm just throwing things at the wall and hoping something's gonna stick, because if something sticks, now I will have a huge thing that's gonna make me successful, because now I'm climbing up this wealth ladder because I got these multiple different streams of income, even though most of them are not really making that much money, but they're taking a lot of time out of me. When I was in this stage, anytime somebody would come to me with a business idea or a money-making idea, chances are I was gonna jump on it because I don't wanna miss out on the opportunity to make something or be a part of something that's gonna make it big. And so I'm just kind of spreading myself here, everywhere, because I want my hands in a whole bunch of buckets, because just in case one of these things make it, I want to be a part of that thing. And so now I have my hands and myself tied everywhere, but I'm not really making that much money because I'm spreading myself way too thin. I am very broad. I have no speciality. I'm not narrow at all. I'm just kind of do a little bit of a lot. I'm trying to be a jack of all trades, but I'm not going really anywhere because my ladder is just staying stagnant. This is what most people are talking about and preaching and pitching when they're talking about multiple streams of income. It's having your hands in a whole bunch of different pots and creating a bunch of different things and trying to create these different income streams. That way you have a whole bunch of different incomes coming in. That way, in case one fails, you got something else to fall back on. Now, this didn't work for me. It works for some people, but for the majority of people, for the majority of millionaires out there, this is not the way that most people become successful or wealthy. It doesn't work like this. If you've ever seen the movie Yes Man, that's kind of how I felt when I was living like this, because anytime a business opportunity or a money-making opportunity came my way, I tried to jump on it because I figured if this one works, if it pops, I'll be a part of it and then I'll be on the winning side of it. But when you try to do everything, at least for me, when I try to do everything and I stretch myself so thin, I ended up really doing nothing. I had, one income stream that was doing pretty well, but the others were kind of just there, and there were learning opportunities, which was nice, but they didn't make me any money. The second type of multiple streams of income is how the majority of people become millionaires. This is where you have a job, you make money, and then you invest some of your money into stocks or real estate or other passive investments that are working to make you more money. This is the one that I talk the most about on our YouTube channel, because this is the one that's most accessible to people, because if you're working a job, now it's all about living below your means. That way you have some extra cash. Now you can deploy this cash somewhere else. That way this cash can earn you more money. But when you are investing this money, the important thing here is you understand the risks involved and you understand the learning curve. Because if you understand the learning curve and you put in the effort to learn what you're doing, you can get a much better return on your money, because now you are not spreading yourself too thin. Again, because you're not just throwing your money in random places. You're putting your money where you know, and when you know where you're putting your money, you can get a better return on your money. Like, I just turned on two very potentially lucrative investment opportunities just because I'm not familiar with these investments and I'm not ready to go through that learning curve right now. One was in this transportation company. They were looking for a financing deal. It was like a $50,000 opportunity and they were promising a really good return. And the other was this hotel. They wanted a $100,000 investment and they were building this really nice hotel in a great area. I turned both of these down because I'm not familiar with either of these businesses and I don't want to go through the learning curve right now to learn how these things work. I want to continue investing in things that I know, and when I got some more time, maybe I'll look into investing in other things. I talk about this when it comes to stock market investing a lot, where you have to pick a strategy. For a lot of people, when it comes to stock market investing or just investing in general, their strategy is throw your money into something and hope it makes you some money. But that's not a real strategy, and it doesn't work when things go wrong. When you want a real strategy, you gotta know what is your investment criteria, what are you looking for, and then invest based on that, because this strategy is going to help you not just when times are good, but when things go wrong as well. You got to know what you're looking for. You got to know what your expertise is, master that. And if you can do that, you will be able to make way more money over the long term, because now you know why you're investing and you know what you're doing. If you're working a job and you have an income coming in, you should 100% be investing some of your money. Now, when you're starting off as an investor, you're not gonna know how to invest. I get that. And so there's a learning curve that you have to go through, but you just gotta understand that there is a learning curve. And as you start to learn, that's when you wanna go from this broad to narrow understanding of your investments. Where are you investing? Are you just throwing your money into stocks, or are you throwing your money into value stocks? Or what type of investments are you looking for that's going to give you the best return? Because once you start to narrow your focus, you're going to understand way more about how to use your money and understand the investments way better. This is where you got to really understand the difference between an active investment and a passive investment. An active investment is something where you put your time into something to make this money, right? Like I talked about earlier. If you want to create an income stream, you got to either invest your time or your money. So an active investment is something that requires a lot of your time. This is something like your job, because if you want to make money from your job, you got to go into work and you got to do something. That's how you get paid. A passive investment, on the other hand, is just where you throw your money into something and then you can turn around, do something else, and continue to get paid. The thing about passive investing, which is cool, is you get paid without doing a task, but you're going to get a smaller return with your passive investing than your active investing, because you're not putting your time in it. It's just your money. When you invest your time and your efforts and your labor, you can get a much better return on your money, but there's a limit to how many active investments that you can do, because we only got 24 hours in a day. So you might be able to do one active investment, maybe two, like your job and a side hustle, or a job and an evening business that you're working on, but that's really it. You cannot manage 7 different active investments and hope to make it big with all of them. You got to start with one, manage one, grow it, and then continue whenever you're making this money to invest it into these passive investments, things like stocks and real estate. Real estate isn't always passive in the beginning, because there's a big learning curve you got to get through and understanding how real estate investing works. But once you get past that hurdle, then real estate can be very passive. This is why as soon as you start making money, as soon as you start getting an income, you want to start putting some of this money towards your passive investments, because this is how most people become wealthy and millionaires, is by taking a little bit of money every single month, every single paycheck, and putting it towards your investments every single time you get paid. That way now you're building this little nest egg that is working to make you money, and as you do that, you're going to build this wealth slowly, and you're going to learn along the way. You're going to learn the different types of investments, and you're going to learn how to grow your investments. So you just got to make sure you keep funneling some of your money into these passive investments. And this brings me to the third strategy of multiple streams of income, which is where you build one stream of income first, one massive stream, and once you do that, now you diversify into your 7 streams or whatever you want to have. Do you remember this ladder method that I talked about before? Now let me show you why I'm not a fan of this method anymore, because let's assume that you have $50,000 and you want to start creating these multiple streams of income. So you already work in a job and you got this extra $50,000, and most of your time is going to your job. Now, one of the things you're going to do is you're going to invest some of this money into the stock market. So you can put $10,000 into the stock market. Then you want to start this business because you want to create this profit income. Well, you're already spending all this time at your job, and now you got to put some money into starting this business. Maybe you put another $10,000 into starting this business, but now you're working a full-time job and starting a full-time business while you're putting some money into your stock market investments. If you really believed in your business, why are you investing in the stock market when you could be funding more money into your business? I mean, the stock market might be able to get you a 5, 6, 7, 8, 9, 10% return a year on your money. But if you can grow your business, you can double your money in a year or 2 years. So now you have a little bit of money going into your business, you have a little bit of money going into your stocks, and then you want to create this royalty income. So you start writing this book. And if you want to write a book, it takes a lot of time, but it also takes money to publish the book and market the book and get it out there. You might put another $10,000 into getting this book out there because you want to create this royalty income. But now if you really believed in this book, why are you putting so much time and money into this different business? I mean, you could just be pushing this book and create this real royalty income from your book. And now you want to invest in real estate on top of that. And you got a little bit of money left. And now you're going to put this money as a down payment to invest in this rental property. But you don't know any contractors. You don't know any real estate agents. You don't know any real estate attorneys. And so you kind of just going through the deal trying to find this way to create this passive income. But you're spreading yourself too thin. You had $50,000. That's a good amount of money. But you're putting some money here, here, but it's not taking you anywhere because you're not believing in yourself in anything. You're just spreading yourself everywhere, hoping something's gonna stick. But when you do everything, you end up doing nothing. That's why for me now, I look at this multiple streams of income not like a ladder, but more like a wheel. This looks more like a donut than a wheel, but let's assume this is a wheel where now what you wanna create are spokes in this wheel where everything supports the central purpose. And as you kind of develop one of these spokes, it helps build the second spoke and the third spoke. But the important thing here is you want to focus on building just one spoke first. Once you can develop one spoke, once you are worth $1 million, now we can start working on the second spoke, and then the third spoke, and then the fourth spoke. And the important thing here is every time you develop a spoke, this needs to help build this one. These need to all kind of fuel each other. That way now you can create a wheel that keeps spinning and working towards you. Show you what I mean by this. If I give Minority Mindset as an example, we started off just as a YouTube channel of me talking in front of a camera. But then slowly we started to grow and we started to make some more money. And then I started reinvesting this money back into Minority Mindset. One of the things that we did was we created a financial newsletter. Now, our financial newsletter kind of supports our YouTube channel because when you subscribe to our newsletter, then we can support our YouTube channel, and our YouTube channel supports our newsletter. We both talk about financial stuff, so we both educate you in a different way. Our YouTube channel is a lot about financial education. Our newsletter is all about what's happening in the financial world, but it's creating a new stream of income for the company. Then, as the newsletter grew, now we're investing heavily into our blog and our website. We have a dozen or so writers for our blog that are writing a bunch of financial education content to provide you with more valuable content, more financial education, and now each of these things are supporting each other. If you go onto our website and read our blog, well, then you might be interested in checking out our newsletter. And if you check out our website, you might also be interested in our YouTube channel. But all these things are supporting each other because if you check out our YouTube channel, you might also be interested in our website. And so all these things are supporting each other all in the financial space. Now, we're working to develop an app. And this is one of those things that's going to come out in 2021. But all these things are supporting each other where it's all in the financial media space. We're all a part of Minority Mindset and we're all building each other. Each one of these spokes helps build the next one, and each of them helps the previous one grow even bigger too. And so now it's not these kind of different things where, oh yeah, let me do some affiliate marketing here. Let me do this Shopify store here. Oh yeah, let me do this freelance hustle here. All these things are uncorrelated, unrelated ladder steps. Now it's a wheel where everything is building each other. You're trying to build the central piece. The tough thing about doing this is you stop being so broad and you get narrow. And the issue that I face, and I know a lot of people face when they try to get narrow, is you feel like you're missing out on a lot of opportunity because now you think, oh, I'm not doing this and I'm not doing that and I'm missing the opportunity to make money here and I'm missing the opportunity to grow my business this way. But when you are not so broad, then you have the opportunity to really focus and make money in a specific niche. And now you're focusing and you can really be the master at one thing. Now, when you can really master one thing, then you can go out and start to get bigger and bigger because you've already mastered one thing and you've built one spoke. But when you're so broad and so general and you try to do so many different things, you end up going nowhere and nobody knows you for anything. You're just there. But you got to focus on one thing, build this one thing. And then once you are worth $1 million doing one thing, now you can really start diversifying and using your money as a tool because now you have the money to do it and you can use your money to help fund these new things, these new streams of income because now you have the capital to do that and you have the one thing to help support these other things. And now as you grow, maybe you want to diversify and put your money somewhere else. Now you have the capital to do that because you have built something and now you have more money, and now instead of you investing your time to build something else, you have the capital to go and invest in something completely different learn how to do it, and use your money as a tool to help grow it. Yeah, maybe you're not going to get the same return as if you were the person doing it, but you only got 24 hours in a day, and your money can go way further than you can. You can scale the amount of money you have, but you cannot scale your hours. And so now when you got this going, now it's all about taking your money and putting it to places where you want to go. Yeah, maybe you built this thing here, now you can invest in commercial real estate here, or maybe you want to invest in hotels, or maybe you want to invest in startups. You can kind of figure out where you want to go and specialize in that, but now you got the capital to help take you there. So when it comes to multiple streams of income are great, but you got to understand how multiple streams of income really works. If you want to create these multiple streams of income so you can become successful or wealthy or rich, chances are you are spreading yourself way too thin if you're trying to do 7 different things at one time. What you want to do first is find one thing, master that, be the best at that, and build that first. Once you can do that, now it's a lot easier for you to kind of go out and be a little bit broader now because you already started narrow. You have built this one thing, you have created this one stream of income, and now you can start putting this money somewhere else. Now you can start investing your money into other passive investments, maybe other active investments, because now you have the capital to help you do that, but it all starts with that one stream of income first. You got to build this one thing, and once you are the master of that, then you can start spreading it out. If you've ever read Made in America by Sam Walton was the founder of Walmart, he talks about this very concept. He says that one of the reasons Walmart became Walmart, one of the biggest retailers in the world, was because he didn't diversify. He kept growing Walmart and he kept his eggs all in that one basket because his most important thing was to build Walmart before he started creating these different streams of income. He wanted to build one thing first, and then was the only time we started thinking about doing other things. Thank you for watching. If you enjoyed this video, here's a video about investing in cryptocurrency that I think you'll love, and while you're at it, download a free guide on how to start generating passive income, and as always, keep hustling.
So they want you to keep in the system, devalue your savings, devalue your working salaries to try and keep this system alive,